All right, let's talk more about the market's earnings and the Fed after last week's inflation data. Joining us right now is Mohamed El-Erian. He is Allianz advisor and president of Queen's College, Cambridge. And Mohamed, first of all, great to see you. Thanks for having me. Joe and I were talking with Andrew earlier this morning just about how it's surprising to see yields that are higher given the weaker than expected inflation data that was out there. That would make you think that the Fed is getting near the end of the rate hikes, and maybe as a result, yields would come back down a little. What happened?
So two things happened. One is core inflation was not weaker than expected at 5.6%, and that's the one to look at. And second, flying under the radar screen are survey measures of inflation. You had the New York Fed last week showing that inflation expectations for this year have gone up a full 0.5 percentage point. You had the Wall Street Journal this morning surveying economists. That's up 0.4 percentage points. So what you're getting is recognition that inflation is going to be sticky at around 4 to 5%. And that's what's been reflected in the 2-year that has traded back up to 4.14 and higher expectations of a 25 basis points hike at the beginning of May.
You think that it's going to be stickier, too?
Oh, absolutely. I mean, I've been saying this for a while, that if you look at how inflation has migrated from a few goods, food and energy, up to the whole goods complex, and now to the service complex, and we're starting to see it in wages. People should follow the Atlanta Fed wage tracker. That's up around 6%. So if you look at what has happened to the inflation dynamics, it's now embedded in the service sector, and it's starting to impact wages. And that's what happens when the Fed is late. That's what has happened in past episode, is that inflation goes from things that are interest rate sensitive to things that are less interest rate sensitive.
Meaning even if they hike rates further, it's not going to have that much impact?
You need to go higher and for longer, and therefore you incur two risks that we've talked about. One is to the real economy, and the other one is to the financial system.
Where do you think we stand with the risk to the financial system? Are we through the worst of it? Do you think there's more to come?
So, you know, I never liked the word crisis because we didn't have a banking crisis. We had a few tremors, and we're seeing that they weren't as bad as a lot of expected. However, if we go higher for longer, you have a lot of levered models that no longer make sense. We've seen what's been happening to commercial real estate. We're not even through that process yet. So there's a lot of business models that will not make sense in this world of higher rates for longer. And I think one thing we're going to discuss more and more in the next few months is not, are we in a recession, are we not in a recession? It is the technicals of the market. How do you delever these over-levered sectors? And you're going to see it when people come to refinance certain activities. They won't make sense at these higher rates.
Is it too late if you haven't already moved on any of those portfolios, on any of those issues? Is it too late because everybody else is figuring it out and you're not going to be able to get the cash? So it's getting hard to just sell them. A lot of people are hoping that somehow they can get through the peak in rates, if you like. You know, a lot depends on whether you have to refinance or not. If you don't have to refinance, then you're fine. But if you have to refinance, that's a moment of truth.